My pleasure to welcome you all to the 17th edition of the Global Investors Conference. This year's theme is Entrepreneurial India. All of us know that India is a land of enterprise and entrepreneurship. But what has changed in the last decade or so is that we've seen a big surge in the uh, first generation entrepreneurship. At this conference, in accordance with the theme, we are hosting 20 of these first generation entrepreneurs, and you will actually get an opportunity to actually hear them over the speaker sessions or in one-on-one or group meetings. We also have 24 speaker sessions and CXOs of 138 companies at the conference. Most speaker sessions, will look to cover the contemporary themes, which include, AI, EMS, manufacturing, and of course, geopolitics and global growth. I'm sure you'll get an opportunity to, attend some of these sessions and also meet companies of your choice. Actually, I'm a firm believer that all of us, for our professional and personal development, learn a lot from sports. And every year we've had a top quality sports professional speak to us, right from cricket to chess to tennis. So every year we have had very good speaker. Tomorrow, Dada Saurav Ganguly, one of the finest batsmen India has produced and probably the best captain batsman India has ever had, will speak in the evening, and we'll follow it up with a session with filled with music, drinks and dinner. The last 12 months have been quite tempestuous, I would say. Lots of news flow, and filled with a lot of greed and fear, and yet markets globally hit new highs, and save India, most markets are almost at their all-time highs, and against this backdrop, there's still a lot of nervousness around as to what this AI disruption will do, what the policy regression globally will do to global growth, and who none other than Dr. Jim to give a perspective on how he sees things unfold in the next a year or so. I worked with Dr. Jim for many years. He brings unique insights into global growth. I remember quite a few reports like the dance of the curly D's and the Janus plays, some reports that are etched in my memory in terms of the how it's exactly played out in the later years. And he's the chief economist at Aletheia Capital, one of the top rated economists in Asia. He's done a big trip to Delhi, met a lot of senior policy makers last week, and I'm sure his session will be very insightful and a great value add to all of us. Over to Dr. Jim.
Many thanks, Nem, and good morning, everybody. Many folk over the last number of years have claimed that I'm not speaking English when I get up and address an audience. And to a certain extent, that's true, because I'm not English. I'm Scottish, as some of you might know. Let me just bring up the... And to prove it, I'm going to read some poetry to start off. The best laid schemes o' mice and men gang after glee, and Leah's naught but grief and pain for promised joy. Now, that was written in the 18th century by a poet called Robert Burns. Some of you might know that every January we celebrate Burns Night, both in Scotland and around the world, because he had some tremendous insights into the human condition. That poem was written by Burns to a mouse that he'd seen running about in a church. But what it's really trying to say is that the plans that we make, whether we're men or mice, often go wrong. And the kind of promise of a good conclusion just result in grief and pain. I thought that was quite appropriate because over the course of the last year, we've been writing reports at Aletheia which address some of the big plans in the global economy. Partly to do with technology companies and their desire for data centers and compute to try and bring AI to life, as it were, and spread the news around the world of a different age, a revolution in technology. And then we've had the plans of the President of the United States to reindustrialize America, make it great again. And part of that has been about tariffs, which of course are in the news this week, and indeed ways of trying to contain America's biggest competitor, which is China. So we've written a lot about these two things over the course of the last year. The year-end strategy report that we produced was called Mother of All Busts. Now, it wasn't actually meant to be about the financial sector and stock market, etc. It's really about bust plans, bust egos. A promised joy of huge amounts of investment that can't take place because they're impossible. That was the year-end strategy report. Through the year, we were actually doing a lot more as regards the reindustrialization strategy of the United States and talking about economic philosophy. We quite like to do that. The mainstream is very Keynesian, as you probably know, almost monetarist as well, whereas our philosophy is very much based in the Austrian view of the world. And the difference between the two is actually quite simple. The mainstream view of the world is a labour philosophy of growth. The Austrian view is about capital and investment, and I'm going to speak a lot more about that as the hour goes on. But they're very different philosophies. So let me, as I say, develop that as we go along. Here's the bottom line, though. The current plans to build around about 80 data centers in the United States, which will help reindustrialize the economy as well as introduce the AI phenomenon, are impossible, given the time scale that is suggested by all of the hyperscalers just now. Because what does this 80 data centers mean? So, the United States has an installed electricity capacity of 4,000 terawatt hours. That capacity has not changed in 20 years. It was 4,000 terawatt hours 20 years ago. It's 4,000 terawatt hours today. The plans that they have for the data centers mean that it has to increase by 20% over the next 5 years. This is what all the hundreds of billions of dollars of new capex expenditure at the top technology companies is implying. So in other words, 800 terawatt hours has to be increased or installed in electricity capacity in the United States in 5 years? Well, impossible. Impossible for two simple reasons. There are shortages of electricity and there are shortages of labour, the things that are most required to build these data centres. And not least in terms of the electricity, what we have with 80 data centres is the implication that the Americans will put in place 80 to 90 nuclear reactors in 5 years. Now, how many have they put in place in the last 10 years? As far as I remember, not one. So not only build 80 to 90 nuclear reactors, not nuclear power stations. Power stations can have more than one reactor. But 80 to 90 nuclear reactors with all the permission, with all the licensing, with all the planning, with all the objections, etc., 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 that will take place to those plans. Impossible. And that's without even mentioning the labour problems. So, I'm going to show you that in a second. What is an alternative? Can get that? Yes, to this. Well, you know, the sad thing is, in Mr. Trump's world, the alternative is China. Because it could do it. It could put the data centres up. In fact, it's kind of got the installed capacity already to be able to handle this. Because there's a very different view of the world in China than there is in the Western mindset and political landscape. And that's that the Chinese leaders are engineers. They live in the real world. They think about how to build the foundations of an economy, and then they spend an awful lot of money on building those foundations, even when a lot of it's wasted. And they increase capacity, they increase the high-speed rail network, they increase the electricity generation network, they increase the number of electric vehicle manufacturers. They do everything to increase physical output. Now, as an Austrian economist, it pains me to say that in this world at the moment, given the requirements and the plans of men, this is exactly the right approach. Politically, I might find it abhorrent in many ways, but in terms of economics and the planning for being able to absorb the expenditures that people are talking about, it's exactly the right approach. Except, of course, the whole idea of Trumponomics is to scupper China. Not going to happen, I'm afraid. One thing that is very much missing from all of the commentary and from all of the plans is time. And that's down to us, and I mean us as economists. Because over the last 30 to 40 years, economists have churned out formal models of the economy, left, right, and centre. Very sophisticated mathematical models, all based on assumptions. And one of the main assumptions that underlies most economic models is that when you flick the switch, the light comes on. And it comes on instantaneously. So when economists build models and put in those models the plans for the future, whether it's capital investment or about the labour force and its ability to adapt to new technologies, the assumption is it's easy. The assumption is it's instantaneous. That's the mainstream of economics. The good news is that there's Austrians like me that are here to tell you that's rubbish. Because the most critical factor in economic activity is time, the critical factor that is missing from every single economics model today. Why is it missing? Because the models can't handle time. Because once you introduce time, you remove linearity. You introduce non-linearity. You introduce potential feedback loops, which might be positive and quite often are negative. And with that, the best thing to do as an economist is assume the problem away. And that's what they've done. And that's why you can get Donald Trump talking about reindustrializing America, as if that was dead easy. We'll bring the factories back from China and we'll put them in America, except you don't have any skilled workers. You don't have the complementary capital in place to allow those factories to work or be supplied. The supply chains are all somewhere else. So there is a solution to the Trump problem of reindustrializing America. And that solution is quite straightforward. You take the factory from China and you put it in America. And you take the workers from China and put them in the factory. And that's it. Easy. That's all you need to do. Hence the reason, for example, 400 Koreans got arrested in America, in Georgia, in the plants that the car companies had put up, because there were no Americans to do the job. There were only Koreans to do the job, but they didn't have the right visa. This is the world that we live in. People don't actually understand the way that economics works, the way that time works, the way that skills degrade, the way that capital is complementary. And if you don't understand that, you'll just make mistake after mistake after mistake. And that's what's going on just now. I've put a couple of, well, 3 references there, if anybody's ever interested about reading them, which put this in more detail. But I'll stop talking about it just now. Just to give you some quotes from the Mother of All Bus report. These were quotes from 2 electricity practitioners, electricity industry practitioners, that I spoke to when I was writing the report, just about the ability for things in the US to be much smoother, for example, in terms of building data centers. And this is the kind of comment that I was getting from them. The grid in America is 50 years old on average. This is not a new technology paradise. These power stations and electricity capacity in the United States are basically old. Now, the interesting thing about that is that that old capital works off analog rather than digital. And by the way, that's a positive in terms of security, because it's the danger of everything going digital and therefore hackable that is perhaps problematic for some other countries. But in America, the grid is not easy to hack. So that's a positive. Problem is, it's very difficult to upgrade. And you need a lot of people who know what they're doing and a lot of skilled workers who are not particularly technology savvy, but they have to be able to weld pieces of metal together. And that's the problem. You know, I as you now know, come from Scotland. 100 years ago, Scotland, believe it or not, was the biggest shipbuilding nation in the world. My great-grandfather was a blacksmith in the shipyards. My grandfather was a ship's plater. He helped build the Queen Mary, one of the liners, big liners that Scotland churned out in those days. My father was a pattern maker, which is another trade that has disappeared over the years, but that was much more to do with wood than it was with steel. Today, and for the last 8 years, one of the last remaining shipyards in Scotland has been trying to build 2 ferries. Ferries that would go between the mainland and the islands. 8 years and counting. no skills, no workers that know how to do it. That's the degradation that happens when times change, other countries come forward and succeed. So you can't replace skills easily. And here's the kind of thing that's happening in America. Ford Motor Company's CEO last year said there's a 5,000 worker shortage for the car industry, his company. 5,000 workers, not 5,000 IT experts, technicians and mechanics. Can't find them. Average salary on offer, 120,000 US dollars a year. Can't find them. They don't exist. The US Navy is about to embark on a submarine building program. Needs 10,000 new tradesmen. 10,000 tradesmen that are exactly the same tradesmen that the electricity grid needs to build out capacity. Can't find them. One of the guys that I spoke to makes switchgear for electric, not transmission, but monitoring in power stations. He said, I've never had so much inventory in my operation, but the average time of taking an order to completion has gone from 16 weeks to between 40 and 70. No shortage of inventory, just shortage of workers. And their last comment to me was applying the scalability of computer programming, which is the kind of Economist assumption of instantaneous, to the physical world is a fantasy. When you switch the switch, the lights don't come on. And that's where we are today. There's impossible economics going on in the thinking of politicians, which has led us to believe that we're in for, as I say, the mother of all busts. But what that really means is a very different view of economic growth over the course of the next year or so. Let me see what I'm doing in time terms. Okay at the moment. So, our view is that the US is going into recession. It's already in recession if it were not for all of the capital expenditure that the technology companies have announced and are trying to build out at the moment. When you look below the technology capital expenditure, what you would see is that CapEx in the US over the course of the last couple of quarters is on average down about 8 or 9%. That's recession. Capital expenditure causes recessions and causes booms. Consumer expenditure does nothing. Consumer expenditure just happens all the time. Very rarely does it move that much through the cycle. The cycle is absolutely dependent on capital and investment. And investment in the United States outside the technology industry isn't happening. And if we're right on the impossibility economics theorem, then the technology industry investment can't be delivered. So then we've got some bigger problems, just to keep the upbeat mood alive at the moment. What are the bigger problems? Well, government debt is out of control. Now listen, if we get into a recession in the United States, government debt's going to go through the roof because we're at a 7% fiscal deficit with economic growth, and economic growth over the last 5 years, and that deficit hasn't come down. If we go into recession, the deficit's not going to 7%, it's going to 10, 12. And with it, nominal GDP growth will come down and the government debt will get much, much worse. Just as we hit World War III. No, don't worry, I'm not going to talk about Iran, I'm not going to talk about Ukraine. It's not about a hard, hot war between America and the rest of the world or whatever. World War III was actually a report that we published in 2016. Some members of the audience have been reading my research for a long time. And as Nem said, there's a couple of things stick in his mind, but what he didn't say to you is that I'm usually a bit ahead of either the markets or where I should be when I'm publishing things. So World War III would probably have been better published about 3 or 4 years ago, but I did publish it 10 years ago. The subtitle was The Coming Conflict Between Generations. It's got nothing to do with countries. It's got everything to do with the promises that politicians have made over the course of the last 50, 60 years of democracy and peace to pensioners, people my age. So, when the UK introduced the universal pension in 1946, sorry to take you back to a long ago time, the pension was introduced for men aged 65. Average life expectancy was 58. The people who designed the pension designed it never to be paid. That was the sensible, common sense view of the politicians and economists in those days. Today in the UK, the pension age is 67. It's gone up 2 years. And life expectancy has gone from 58 to 79. Everybody's going to get a pension. Not quite everybody, but most people are going to get a pension and get a pension for a long time, just as there are fewer and fewer young workers to be able to pay for the pension. Because of course, like most Western countries, the UK doesn't have a pension scheme that is an account that each of us own. It's just a general taxation called national insurance that goes into the system and then is paid out in pensions. So these become contingent liabilities in the books of the government, and those contingent liabilities are about to come home to roost. So when you see the US debt at 120% of GDP, in the UK around about 100% of GDP, in 10 years' time, add 20 percentage points to that. Easy. Because pensions will be gobbling up the income of everybody else. As a taxpayer in the UK, I think I need to move back to Hong Kong. That's about the only solution. So, there's a huge problem coming with government debt, and I think bond markets are beginning to realise it. There's a growing chasm between bond yields in the rich countries and those in fiscally prudent Asia. I'm going to show you that in a few minutes. Let me leave these other comments alone and just show you what is happening, unusually. It's okay, now we got into charts that I can go a bit faster. It's not going to be all words. What do you see here? So this chart here is the United Kingdom. And before I show you the United States, I want to show you this one, because this is the canary in the coal mine. Interest rates began to get cut in late 2024 in the UK. They've been cut 6 and maybe 7 times since then. 10-year bond yields have gone up. This doesn't happen. Short-term interest rates will have followed the policy rate down, but normally long-term interest rates follow the policy rate down as well. Maybe not quite as quickly or as much, but always they follow it down. Now, no. What's that saying? Apart from saying you've got an inflation problem that you haven't addressed, yes, also saying you've got a debt problem, a big debt problem, a big financing problem coming, and we don't like it. In Japan, it's a different story altogether. This is the nuttiest country in the world, and I'll come to that in more detail in a second. Here, interest rates are going up, but nowhere near as fast as bond yields, because they don't even know where the curve is. And some of the policies that they're following just now are going to make this much, much worse. And if any of you are interested in the carry trade in Japan, and you should be prepared for the plans going after glee very wrong. because this is the biggest danger in the global economy at the moment for markets. But what about America? Same story. Interest rates begin to get cut here, September 2024, cut, 175 basis points. 10-year yield, up 50. Not responding. If they have to cut interest rates into a recession, my guess is that 10-year yields will be at 6 or 8% rather than 2 or 3, because the debt implications and deficit implications are too horrendous. And remember, this is at a time in America where, I'm afraid, you might like him, you might loathe him, whatever you do, you can't deny that Donald Trump is a disruptor, and what he has disrupted most is trust in the dollar and trust in America. So one of the main sources of financing for US government bonds has disappeared. It's called the foreigner. And I'm not just talking about China, not just talking about Asia, talking about Europe, talking about every country, every region in the world that's looking at America and saying, can't trust it. That's the feedback I get from people every meeting that I'm at. We wrote a report last week, published a report last week called Just in Case, Not Just in Time. We've moved away from the just-in-time world completely. People are building in redundancy. They're building in multiple supply chains. They're building in lots and lots of different views of how to deploy their money. They're not doing it efficiently. It's going to be much more costly going forward. But it's scared and fear and worry about what's coming from the biggest country in the world. And they haven't even thought about Japan. Let me tell you. So let's turn to a better part of the world. And we're sitting in it just now. Our view, and you'll see from the last slide that I'm not just making this up because it's an Indian audience, but our view is that Asia looks really rather good. And specifically looks very good from the perspective of the two big countries in Asia, India and China. Because for different reasons, the domestic economies in those countries are likely to be revving up over the course of the next few years, regardless of what goes on in the United States and Europe. Wouldn't be immune from market moves, especially if Japan is the problem that I think it is, but economic growth terms and the attractiveness of owning assets in these countries is going to increase. These other comments I'm going to jump over just now because I'm going to show you the charts. Let me start with China, because I know some people will be interested in China. Here's a very interesting kind of picture, in my view. Asianomics, that was the company that I had before I moved into Aletheia. Asianomics still actually exists within Aletheia, but I stand as the Aletheia Capital chief economist. Asianomics is what I kind of think of in my own company terms. At Asianomics and at CLSA, we developed a lot of models about the economy, developed models. I don't do models. I do theory. And this is theory about what drives economies. The most important thing in every economy is profits. If profits are not available, investment doesn't happen. If investment doesn't happen, the economy doesn't grow. Simple. That's it. That's the model. So what have we got here in China? This is a profit recession. Now, the reason that I've got ROEs here is that we don't get profit numbers for GDP figures in countries like China or India or most emerging markets. In the United States, you do. So that's fine. We can use national accounts data for profits in the United States to identify the profit cycle. In these countries, we're trying to find something else. So we use, as a proxy, return on equity in the stock market. Some countries that works quite well. India, China's okay. India's very good, actually. Some countries it's terrible. Taiwan, because one company is 40% of the market. So that's a problem. However, what we're trying to do here is see the pattern of profits. And when you get ROEs that are down from 12, 13% to 10, that's telling you you've got a profit recession. The economy has been struggling in China. Now, here's the thing. Profit recessions historically last for about 2 years. Why? Well, because during those 2 years, bad companies either go out of business or get swallowed up by good companies. Schumpeter called it creative destruction. But you begin to get a consolidation in the economy, in various industries. China's talked about anti-involution. Don't even actually ask me to define that because it's nonsensical. Which is supposed to slow the process. It doesn't slow the process. Process is inevitable because it's private. It's not public sector companies, it's private companies. So China is in the process of consolidating its business environment. As I say, we think that at the end of that process, there's lots of questions I'm quite sure you've got here, but bear with me. What about companies that are beginning to restore profitability? Have they got an incentive to invest? That's what the second chart tries to show you. This is the real lending rate in China, and you'll see it for other countries in a minute. What we're doing here is calculating a rate of interest that businesses face in the economy. Nothing to do with government bond yields, nothing to do with official interest rates, everything to do with the bank lending rate. What real companies face in terms of a cost of doing business. And then we deflate it with trend nominal GDP growth, not the CPI. Why? Well, because in Austrian theory, the rate of interest is equal to the rate of profit is equal to the rate of growth of the economy. We don't need to go into the Austrian theory because that's lots of books that we'd need to go over. But that's the philosophy behind it. So what we're looking for here is a real lending rate close to zero, because that's a good signal for companies. If they think they can beat the nominal rate of growth over time because they've experienced it, then invest. If they can't, you don't invest. What happens here when you've got a real lending rate at -10? Don't put your hands up because you probably all know the answer. It's what's called malinvestment. You encourage too much investment. You encourage too much investment in all the wrong places. Apart from anything else, the only people that everybody wants to borrow, but the only people that can borrow from the banking system, since it has limited funds, are the ones that are favoured by the banks, which in China's case over most of the last 30 years have been state-owned enterprises. So you get massive bad investments going on. By the way, at this point in China, they had to recapitalise the banking system, which many of you probably remember. Because they had such bad debts, such high bad debts. Here, after the GFC, global financial crisis, China saved the world and really destroyed itself in the process because they ended up with huge investments. The government said, lend. The bank said, who to? State-owned enterprises said, us. And the banks preferred them because they were safe, that they might go bust, but the government will step in and pay the money back. And what they ended up with was 30% overcapacity in cement, steel, glass, chemicals, shipbuilding, you name it. Huge property boom, everything. That was the problem. So Xi Jinping has been sorting that problem out for 12 years. So let me just mention one thing before I move on from this. 2021, everybody says, no, Bloomberg says, don't believe Bloomberg. That's all I would ask you, don't believe Bloomberg. Bloomberg says China had a property crisis, and that property crisis is ongoing. China has not had a property crisis. Property crises, or crises in China, are met with immediate policy action. When the Chinese perceive a crisis, as I've said to people over the course of the last 2 days, they reach into their toolkit and they pull out the one thing that they've got in it, and that's a sledgehammer. And they hit it and hit it and hit it until they solve the problem. What have they done with the property crisis? They've let it go. Let it go. Let it go. What that's telling you is that it's deliberate policy action. They wanted to shrink the property sector. They have shrunk the property sector. Started off in 2021 about 20% of GDP. Today, on our calculations, 11. Done. Job done. Part of the reason that this profit figure will start ticking up, and this is a good time to buy Chinese stocks, equities, is because the property sector crisis is done. It might continue to have negative numbers for a wee while, but it doesn't matter because it's such a small part of the economy now. And other things will be happening in the background, not least significant amounts of effort going on to make Chinese services an engine of growth. When everybody tells you that China's consumption level is very low in relative terms to America, it's true if you're measuring consumption as a percentage of GDP. If you are measuring the sale of goods as a percentage of GDP, China's goods sales are higher than the United States. Its big problem is it doesn't provide services, and that's a problem it can fix. And by the way, you just need to read the government statements. That's what they've been talking about for 2 years. Haven't done much about it, but they're about it. And that's where the growth will come from. It'll also come from, I'm afraid, exports. Here's just an amazing picture. This is in dollar terms, billions of dollars. There's two scales in the chart. Obviously, the first one is, this one is exports to the US. The other one is overall exports. Last year, China's supposedly biggest market, the US, exports decreased by 20%, and yet overall exports went up. And lots of people will say, oh yes, because of transshipment and things like that. Well, yeah, maybe partly that, but actually no, because of that. The dark blue line is the China dollar, the renminbi dollar exchange rate. This is the real effective exchange rate. China has become more and more and more competitive over the course of the last few years because it's got its economic policy in exactly the right position. No inflation, best thing in the world. No inflation, while everybody else is inflating. So China's competitiveness has been rising and rising. That's why its exports are so strong, and they'll continue to be strong. So they're underpinned by export performance as well. Even in a global economy that might be softening, this will still be a positive for China. Then there's a services story. So buy China. And buy India. Despite the fact that that would be a chart that would make me usually as an Austrian economist say, ooh, possibly time to sell. Because we've had such a good run in the profit cycle. But what you're looking for in an economy like this is signs from the government or signs from the authorities that they know what's happening. So the last week or so, we've been talking to Indian economists, government officials, journalists, And I'm now much more confident about our Buy India call than I was a week ago. And I'm quite well positioned myself in that regard, whereas a lot of foreigners have been selling into this for the last few years and are not very well positioned in that regard. Well, that's their tough luck. They've taken profits at exactly the wrong time in India, in my view. What's happening here is that the recovery, now, just to re-emphasize, 2 years of profit recession. Same as China at the moment. India, 2 years of profit recession, then recovery. That's what happens, consolidation and then recovery. And then India has had very good years of return on equity. The profit cycle has turned way up. At a point now where there really is nothing to be done on the policy front. I mean, it is a rather astounding story in India. 30 years ago, you would just never have imagined that Indian monetary policy and fiscal policy could be so well run. But it is. The RBI needs to do nothing at the moment as regards business startups. There's going to be third-party certification rather than factory inspectors coming to see the companies. In other words, rent seeking is going to be hopefully eradicated, but that'll take time, but certainly reduced substantially. And it's going to be much easier to start a business and much easier to have a business flowing between having 9 employees or 19 employees and 100, 150, 1,000. And that's absolutely essential just now for India because of demographics. The Chinese realized this at the start of the 1990s, that they had to create 10 million jobs a year. And for 20 years, that's all they were focused on. Starting now, that's all India will be focused on. 8 to 10 million jobs a year. And that means getting rid of the regulation, making it simple, making it easy to do business. And that message is obviously there at the highest levels, which is really good news. Do they need to worry about interest rates? Actually, in our model, the RBI could raise interest rates and it wouldn't be a problem. It won't. The interest rate signal to Indian businesses is spend, invest, get on with it. And from what I'm hearing from the banking economists that I've spoken to in the last week, that started. Now, during this period, it's not as if Indian businesses were not investing. This is a myth. The government was doing a lot of the investment, but I think Indian businesses were consolidating, were buying up assets that were available. It wasn't new capital expenditure. It wasn't capital expenditure that would be appearing in the national accounts, but it was capital acquisition, probably to a certain extent reducing poor capital, but also increasing the ability to make money when the time came for the capital expenditure to increase through the banking system. And that now seems to be today. So this is really good news. India has the best investment to GDP ratio in Asia just now. Investment has continued strongly over the course of the last few years, and I think that's about to pick up even more. I want to jump over that because a wee bit of time and just mention this country because I talked about it earlier. Let's not bother with the profit figures and the real lending rate because to a certain extent, Japan's just stuck. It can't actually have an investment cycle. And there's a very simple reason, because it's an even more impossibility territory than the United States. And here's why. Full employment, red line. That's the Japanese unemployment rate. Mrs. Takaichi wants to be Mr. Abe Mark II. Mr. Abe Mark I, when he took power in 2012, had 4.5% unemployment to deal with. Remember, the global financial crisis had occurred. It had hit Japan hard as well as other countries. Unemployment had risen 4.5%. Abe came into office, spend, lower interest rates, get the exchange rate down, try and get the economy moving. And, you know, in fairness, I didn't like the policies at the time, but he achieved what he was trying to do. He got unemployment down to 2.5%, actually to 2%. Fine. Mrs. Takaichi wants to do the same thing with unemployment starting at 2.5%. What's she want to do? Get it down to 1? Nothing. Who knows? Because it's madness at the moment. Fiscal expenditure is going to go up because what she wants to do is subsidize consumer prices, which have gone up, which was the policy for the last 12 years, to stimulate consumer prices, get them up. Now she's going to increase spending to get them down. Now, if you can square that circle, you're better than me as an economist, because I can't get it straight in my head. All that will happen with increased spending is inflation will go up, because there's no resources. Can't go into capital expenditure, nobody to man it. Can't get into just growth, because you need capital expenditure, nobody to man it. So this is the economics of the madhouse, which will end up with significantly higher interest rates, which will then unwind the carry trade. So for all of you who are sitting there with Japanese investments, which are dependent on a weak yen to make them look good because of translation gains from offshore activities, imagine the yen at 135, not 155, because that's where we're going. I didn't talk about the dollar, but I couldn't do that in questions. And here's what Japan really is these days, a tourist destination, because it's cheap. The Japanese voted for Mrs. Takaichi because she was standing up to China, not because of her policies on economics. But basically, the rest of Asia just goes to Japan for a holiday now. It's a nice place to go, good food. So let me jump over these regional prospects. I'll leave that there and stop for questions, because I'm getting tired.
So we should turn it over for questions?
Yep. I think we've got a bit of time.
Do we have a question for you? Can we get the mic sent to him?
Yes. So the question was, if skilled labour is a problem, why raise barriers to the movement of labour? Which is an exceptionally good question. And I suspect that Indians are thinking about it as an H1 visa and what have you. I could actually give you the answer that I want to give you, which is that because you're stupid if you're running that policy. But maybe it's just because they have a problem with immigration generally and they want to reinvent American workers to be the people to do the jobs, so they don't want anybody else to take them, even though that makes no sense whatsoever. I don't know. It just is a crazy policy. At the same time, it's difficult for an administration that has been elected on an anti-immigration platform to continue to accept immigration, even when it's good quality. It's an opportunity for the rest of the world.
Thanks.
Oh, G2.
Dr. Jim, look, if I just go back last 30, 40 years, the one policy of emerging markets broadly has been to keep the currency weak. To keep the currency weak.
Yes.
And then manage inflation through monetary and fiscal tightness is needed, right? In the current environment where the external balance sheet of the US is broken, the dollar looks like it's much weaker. No one wants to buy US Treasury. And as we saw, the yuan is appreciating on the margin, and my sense is it's going to be much stronger a year or two out, and then a lot of other EM currencies will also be stronger. Do you think this 40-year-old policy of weak FX, tight money, tight fisc is going to turn on its head and policymakers are going to get caught on the wrong foot?
It's a very good question, and it'll be a difficult one for policymakers to abandon quickly because it's in their mindset. But, you know, I didn't mention the dollar, despite talking a bit about the United States earlier. So our view is that the downside for the dollar this year is at least another 6% before it falls another 20% over the next few years. And that would take it back to around about 2007 levels. You know, the dollar is strong, and it's still strong. Where it is just now is actually not even at the levels it was at 2017, 2020. So I think that we go there this year and then gets weaker. And under those circumstances, regardless of what policymakers want, other currencies are going to appreciate. Now, the big problem for me trying to espouse that case is that it kind of means that the euro has to get stronger. And why that should happen is beyond me. Definitely think the yen gets a lot stronger from here, whether the Japanese like it or not. But Asian currencies are the next in line. So if you look at the numbers just now, it's quite interesting because the Thai baht, let me show you what I didn't. That's our strategy call as it stands just now. So you can see that I'm not talking nonsense when I say long India. We've been long India since 2022. We've actually just gone long China in September 2025. But here's one of our worst calls. Short Thailand, which is a trade that's now down 12.6%. But look at the numbers. The SET, when we introduced the trade, was at 1428. A couple of weeks ago, it was at 1430. And yet we're down 12.6% because we mark everything to dollars. The baht has been strong. The ringgit has been strong. The Taiwan dollar should be strong, but they get away with murder because they're pals with America and they're enemies of China. So nobody looks at the fact that they've got a 15% current account surplus in a currency that doesn't move. They're the biggest cheats in Asia and the world. But elsewhere in the region, we're going to see strengthening currencies, for sure. So even if they don't want to abandon the cheap currency export growth strategy, it's going to happen anyway, G2.
So the segue to that is, if I'm sitting 3 or 5 years out, places like India, Indonesia, large pop markets, you're going to have far easier monetary and fiscal policies than most economists would have put in their models today.
Yes, I would expect so. But you know, even India, I don't expect the rupee to be very, very strong. There's still an inflation differential a bit, but it's going to stabilise. And if we get a return of foreign investment inflow in the equity market, which I think will happen, and then the bond market opens up, the rupee's got nowhere to go but up, even if it's slight up.
So, one follow-up, and this is what's been foxing us. Everything looks nice for India, and India is the worst performing market globally. Why is that happening? What are we missing?
So, yes, I've been asked this question a lot over the last 2 years, and why is it still happening is one of the ones that I get quite continually on my phone. So, 2 years ago, when the selling started, valuations, as you know, were very high in the Indian stock market. But not only that, because it was at the time, slides are earlier, where interest rates were high in the United States. And actually, as you know, with the chart that I showed you, bond yields, bond yields are still quite high. So one of the big moves had been into private credit and private equity. This blue owl thing is something to watch, by the way. This is the beginning of the problems in the United States, because private equity and private credit were always going to be the source of problems when interest rates don't come down as expected. But with interest rates where they were 2 years ago, the private equity companies in particular needed to find ways to realize investments because they had dividend flows or payment flows to continue. Where was the best place in the world to realize investments? Here. They had put huge amounts of capital into startups. The Indian stock market was highly valued. They could list IPOs and get a big return, which allowed them to help pay out their US bondholders and shareholders. So I think the selling started for FIIs mostly through private equity and the valuations. And of course, as the market began to either steady or weaken, that intensified the selling because there was big profits to be made. But that doesn't explain the last year. And here, I think, is the unfortunate aspect of the global economy now when it comes to money management. We've moved so much to passive investment. So what happens when a market underperforms for passive investors? They have to sell. And they can sell as much as they like, but of course, as they sell, the market goes down. It is under pressure, so they sell more. And if the active managers are looking at other things at the same time, for example, beginning to increase exposure to China for the first time in 5-10 years, then India falls by the wayside for at least a few months, a few quarters, a year. Now, I think we're done with that. But proof is in the pudding. We need to see what happens over the next 6 months, 12 months. But I think that was a sequence of events that the unfortunate thing was that India was a perfect market to take profits in, even if it meant selling out in very good quality investments. And then it was a case of being the underperformer became the underperformer by dint of that passive investment. No good reason to sell, but that's what happened.
Got it. Thanks.
I'll slip in a question.
Oh.
What's your view on gold? Maybe you can tell people.
So gold, we did go long when it was too, people just think that Austrian economists are always long gold. And to a certain extent, that's true, because for us, it's a hedge against central banks and the ability of central banks to manage the fiat money system. But in 2024, I got really convinced that they didn't have a clue what they were doing. And that's why we went long gold at that point. So it's one of our best trades. Actually, it probably is our best trade over the course of the last few years. I was at a conference in Vietnam in November last year when gold was maybe about 4,500 or 4,000 something. And somebody said to me, do you think it can get to 5,000 in 2026? And I said, I think it can get to 10,000 in 2026. So we're long gold, and we continue to be very long gold. This is about the markets realizing that central banks don't know what they're doing. Not the RBI. Actually, the RBI is lending, or has introduced policies where you can take loans out against your gold holdings. Very sensible, in my view.
Yeah. Hi, Jim. Yeah.
Oh,
So your the thesis about how the debt, I would say, dynamics in the developed markets, right, which have been typical capital providers for the emerging markets in general, right? If it is going to evolve in that direction, especially when the longer end and the tenors of the bond yields are going to be staying elevated, does it create a problem for a capital-starved economy like India structurally?
There's always somebody smart enough to ask that question. When I've tried to give you a really good story and all the reasons about why you should be long India, yes, the unfortunate thing is that in capital markets and markets generally, when the big countries are in trouble, there's a flight to safety. Now, the safety used to be called the US dollar. I'm actually not quite so sure that that's going to be in the mindset anymore. I hope it's not. But there will be a period of turbulence, if I'm right on this analysis, where it will be very difficult for emerging markets to really advance and advance quickly. I think they can easily outperform, and especially if the growth dynamics are right. And I think India, the growth dynamics are right. China, the growth dynamics are going to come right. Elsewhere in the region, it's a wee bit more tricky to be confident that there are some interest rates in real terms that are way too high in Southeast Asia, which is problematic. But yes, it's a wee bit of a leap of faith to believe that if there's big problems in America and other developed countries, emerging markets will be unscathed. But I think if you look through the turbulence that will begin to roil markets, emerging markets, especially in Asia, look as if they're the ones to weather the storm.
There is a question from the gentleman over there.
Jim, so it's pretty public. The Japanese central bank is selling US Treasury. So are the Chinese, so are the Japanese, so are the Indians, so are the Brazilians, so are some of the wealth managers in Singapore and Dubai. And the data shows 32% of all new US Treasury issuance is being bought by Cayman hedge funds. Okay. Can you tell us, and that number is quite large, and Cayman hedge funds holding of US Treasury was 500 billion a year ago, it's 3 trillion today. Can you explain what you understand by a Cayman hedge fund which works under low levels of regulation relative to the US, and who owns that, what's going on there?
Yeah, I mean, I don't know the answer for sure, G2, but it would be, I think, quite unusual for the Chinese not to use different routes to deploy their money. It's all very well officially to reduce holdings of treasuries and what have you, but you still need to put the dollar somewhere. And the problem is that there's not an awful lot of liquid, easy deployments of big amounts of dollars. So I think a lot of the Cayman hedge funds are just fronts for central banks that are, if you like, round tripping so that it looks as if they're selling, but in actual fact they're not. Now, having said that, I think they want to sell, and they don't want to be seen to be holding US Treasuries anymore. And I think that's a general view in the world. I mean, we come back to the whole issue of trust. Currencies, and especially fiat currencies, exist solely on trust. They're not backed by anything. Remember that. If trust erodes, then the value of that currency erodes. I mean, always everybody looks at the gold price and says, oh, look, it's at $5,000 an ounce. You don't really need to look at the gold price like that. You look at the dollar and see what it's worth in gold. And it's down 98, 99% from when gold was removed as the numeraire in 1971. That's currency weakness, and that's a loss of trust in central banking. So, yes, I think long answer to say they're still buying US Treasuries. It's just that they're not doing it in their own name at the moment. I think time's up.
We have run out of time. And I'd like to thank everyone for attending this, and thank you, Dr. Jim, for an excellent talk.